Decentralized finance, or DeFi, is a new and innovative financial system being built in the crypto space with lots of money-making opportunities. But with all this innovation comes some very real risks, and that's where DeFi insurance comes in. I've personally been building software and teaching people about the crypto and Web3 space for many years now, and today I'll be taking a look at what DeFi insurance is and how it works. So in the next few minutes, you'll be able to learn a bit about it and how to leverage it to protect yourself in the crypto space. Now, as I say, DeFi offers freedom, speed, and accessibility, but with this innovation comes some very real risks. And DeFi insurance is still very nascent and mostly a niche sector within crypto. However, as DeFi continues to grow rapidly, you can bet that DeFi insurance will follow suit. It's worth remembering that insurance in traditional finance, or TradFi, is a multi-trillion-dollar industry. You see sort of the size of the companies, the assets that some insurance companies have, right? It's huge. And at its core, DeFi insurance provides a way to protect your crypto transactions from unexpected loss. You can think of it a bit like a crypto safety net, which is pretty important considering just how many hackers and scammers the space unfortunately has. DeFi Llama reports that over $11.3 billion has been hacked in crypto since 2017, with over half of that, around 6.4 billion, being in DeFi. Just earlier this year, we had one of the largest hacks ever in crypto, where Bybit were hacked by the North Korean-backed Lazarus Group for over $1.4 billion, which I actually wrote about before and made a video about before that you could check out. Bybit is a centralized crypto company, but this specific hack that they suffered was done through attacking the interface of one of its multi-sigs. It's a DeFi thing. So it could have easily been performed on many other DeFi projects too. Since then, that money's been laundered, and Bybit have had to swallow this gigantic loss, which has been terrible. And the truth is, you can see crypto still in many ways like the Wild West of finance. And so this is exactly why DeFi insurance is very helpful and great, right? While it can't cover everything, it can provide peace of mind for key areas like smart contract exploits, protocol failures, stablecoin depegging, and in some cases custodial risks. So how does it work? Well, DeFi insurance platforms usually operate on a pooled risk model. So users pay a premium into a shared pool of money. They're paying a premium into a shared pool of money, which then covers claims when things go wrong. For example, if you're using a DeFi platform or holding funds in a yield protocol, you can purchase the coverage for specific risks related to that platform, assuming the insurer supports it. And then when a covered event occurs, like potentially the platform gets hacked, a claim can be submitted, and if it's approved, you'll be compensated from this pool. So the premium, that compensation comes out of the pool and back to the user. It's actually quite simple to understand and very similar to how traditional insurance, or most traditional insurance, works. But it's generally managed through smart contracts and in some cases governed by DAOs. Some policies trigger automatically based on certain conditions, while others require community votes to validate that claim. DeFi insurance is still in its early days, but several players have already emerged, the largest being Nexus Mutual, with over $160 million in TVL, as you can see here from DeFi Llama. Nexus Mutual alone accounts for almost 90% of the entire sector in terms of TVL, right? 160 out of 183 is almost 90%. And it operates as a mutual, meaning that its members run its governance. Similarly, 3F Mutual, which you can see here, also operates as a mutual, but it's tailored specifically for protection if MakerDAO, which is a specific protocol, were to shut down. Meanwhile, other players like ease.org try to mix earning yields, that you see ease here, with insurance by allowing you to wrap up your assets in an insured pool that earns yield. I personally think this adds an unnecessary layer of risk to their insurance model, but they're still one of the biggest ones out there, right? But this is a tough space to win in, and some of the largest players in DeFi insurance, like InsureRace and Unslashed Finance, have mainly faded away and sort of disappeared. Fundamentally, though, you can see these platforms all offer some variation of coverage, right, and a claims process, where the ultimate goal is to bring reliability and protection to this very volatile and nascent space, right? DeFi insurance is so new that there's still a lot of room for disruption, even the bigger players like Nexus Mutual. I personally anticipate that we'll see some big names in TradFi eventually trying to muscle their way in here. If you remember, as I said at the start, TradFi insurance is a multi-trillion-dollar industry, right? So as soon as DeFi grows, they'll come in too. Now, DeFi insurance is great for reducing specific technical risks, especially when you're engaging with new protocols or locking up large sums in smart contracts. But it's not a silver bullet. It's still very nascent space, and most platforms won't cover user errors like sending funds to the wrong address or falling for scams, phishing scams, right? That's why you've still got to make sure you follow best practices with your Web3 security by doing things like don't click on unknown links, make sure to use hardware wallets for protecting large sums of money, verify a protocol's legitimacy before interacting with its smart contracts. You can use burner wallets as well if you're unsure, and never ever share your private keys or seed phrase with anyone, right? One of my very first posts in this blog was on Web3 security, where I expanded on these concepts and how you protect your money. So if you haven't read that, you can find that here. Now, DeFi insurance is one of the most important yet underrated tools in a crypto user's toolkit. As the space matures, we can definitely expect more robust and user-friendly insurance options to emerge. And honestly, I think it's only a matter of time until traditional finance players also get involved, right? But until now, until then, until these players grow and the others come in, just stay cautious, be informed, and consider using what's already out there when it makes sense for you. Stay safe out there in crypto. Now, before we leave, if you want to learn how to grow real lasting wealth through crypto, join a community of like-minded individuals and access over $1,900 worth of courses entirely for free, then click the link in the description below, and I'll see you there.